Welcome to the deep dive. You sent us a really intriguing stack of sources today, all centered around a concept that's, well, absolutely vital in certain financial markets. Priority rights. You sometimes hear them called rights of preemption, too. What really struck me about these materials is how they managed to connect the nuts and bolts of stock market operations with some pretty deep dives into legal and ethical thinking. So our mission today is to unpack exactly what these rights are, why they might matter directly to you as an investor, and then explore the really nuanced discussions around whether they're permissible, particularly from an Islamic jurisprudence angle.
It's quite remarkable, isn't it, how something that seems like a fairly straightforward financial tool can actually open up these complex debates about, well, the very nature of wealth and what counts as a permissible transaction. So yeah, we'll be breaking down definitions, walking through some practical examples, and then getting into the scholarly discourse around it all, drawing specifically from research focused on markets like Saudi Arabia.
Okay, let's jump right in then. We've heard the term priority rights, but fundamentally, what does that mean in the stock market context?
Well, if we start really broad, a right in just basic language means something established or maybe obligatory. In a more legal sense, it's an established obligation or maybe a ruling that aligns with reality. You can classify rights in different ways, too.
How so?
Like by who owns them, God's rights, human rights, or by their financial nature. Are they financial or non-financial?
Right, okay. And so where do these priority rights fit into that bigger picture? Because it sounds like we're zeroing in on a specific financial right here.
Exactly. The Saudi financial market, Tadawul, defines them very clearly as tradable financial securities. What they give the holder is essentially the first opportunity, the right to subscribe to new shares that a company issues when it decides to increase its capital. Think of it as an acquired right. It goes to all the shareholders who are registered right at the time of the company's General Assembly meeting that approves the increase. Basically, if you hold one existing share, you generally get one priority right. That gives you the first shot at buying one new share at the offering price before anyone else gets a look in.
Okay, that's a clear definition. So for someone listening, maybe someone who actually holds these rights, what happens next? Can you walk us through the typical process?
Yeah, sure. It generally follows a few steps. First, the company's General Assembly has to approve the capital increase. Then, almost right away, those priority rights get added to the portfolios of the existing shareholders. From that point, the holders, well, they have two main choices. They can either subscribe to the new shares themselves, basically, use their right to buy them, or they can sell their rights to other investors out there in the market. And anyone who buys those rights from an existing holder, they then get the ability to subscribe to the new shares. Any shares that aren't subscribed to through this whole process, they're typically sold off later, maybe to the public.
Now, this is where it gets really interesting for you, the individual investor listening. Our sources have a great example. Imagine you're like Muhammad in this scenario. You own 100 shares in, let's call it, Mecca Company. Each share is currently worth, say, 20 reals. Now, the company decides it needs more capital, so it plans to issue one new share for every existing share you hold, but at a lower, sort of attractive par value of just 10 reals.
Right. So once the General Assembly approves that, your portfolio, just like Muhammad's, gets credited with 100 priority rights. You now have your original 100 shares plus these 100 new priority rights. And you're facing basically three distinct choices.
Okay, what are they?
Option 1, subscribe. You pay 1,000 rials, that's 10 reals, for each of your 100 rights, and you convert those rights into 100 brand new shares.
Got it.
Option 2, sell. You could sell your 100 rights to somebody else on the market. If, let's say, each right is trading at 8 reals, you'd get 800 reals cash.
Simple enough.
And then there's a third option, neglect. You could just, ignore the rights, let the subscription period close without doing anything. In that case, you get absolutely nothing from those rights. And here's the really critical part.
Yeah.
You actually lose value from your existing shares because the market value of your old shares will almost certainly drop by roughly the value of that new issuance.
Oh, wow. So doing nothing actually costs you.
Exactly. It's a common misunderstanding that these rights are always just a pure bonus. Neglecting them can definitely have a negative impact.
It really highlights the choices, doesn't it? It also brings up a pretty important question. Why do companies even do this? Why issue new shares and create these rights in the first place? What's the strategy?
Well, companies do this for several strategic reasons. They might, for instance, need more financial liquidity, maybe for expansion, new projects, whatever, and they might prefer issuing shares over taking on more debt.
Right. Debt comes with interest, covenants.
Precisely. Debt has its own baggage. Another common reason is maybe they've accumulated profits, and instead of paying cash dividends, they decide to issue new shares proportionally to existing shareholders. That way, they increase the company's capital, but keep the cash inside the business. Ultimately, these are, technical financial methods the company chooses, but the underlying goal is usually stated as being for the benefit of its shareholders.
So if I'm hearing you right, it's not just about raising capital. It's also fundamentally about protecting the interests of the people who already own shares.
Exactly right. That's a key protection mechanism. Think about it. If a company issues new shares at a price lower than the current market price, which, they'd only do after careful study, the value of the existing shares is likely to drop.
Dilution, yeah.
Right, dilution. So, to protect the current shareholders from that, these new shares are offered to them first via these priority rights. It ensures the new shares are distributed proportionally to their existing holdings, which helps prevent potential injustice or undue loss of value for them.
That makes sense. Now, our sources also get into a really fundamental debate for our discussion today. Are these priority rights actually considered wealth, or mal, as it's known in Arabic from a legal standpoint?
Yeah.
This classification sounds like it's absolutely crucial for figuring out if trading them is okay.
It really is. It's a pivotal point for legal permissibility. Across Islamic jurisprudence, scholars have historically had, three main views on what actually constitutes wealth, or mal.
Okay.
View one comes from the majority of scholars from the Maliki, Shafi'i, and Hanbali schools. These are major historical legal traditions in Sunni Islam. They basically say anything with a permissible benefit is wealth, and so you can exchange it.
Anything beneficial and permissible. Got it.
Then you have view two from the early Hanafi school, another major tradition. Their view is slightly different. Anything that can be possessed, acquired, and customarily benefited from is wealth. A bit more specific on possession and custom.
Okay. And the third?
View three is a later development within that same Hanafi school. They refined it to say that wealth refers more specifically to value itself, think dirhams and dinars, actual money rather than just any beneficial item.
Interesting distinction. So where do priority rights land in all this?
Well, the sources we looked at conclude that priority rights are indeed considered wealth, mal, according to the preferred definition. That aligns with the majority view and also that later Hanafi position. Even though they represent, an abstract right on paper, their benefit is very material, very tangible. It's directly linked to the actual shares you can subscribe to. And crucially, people in the market recognize them as having clear value. They trade them for cash. They can be valued just like tangible assets. The fact that even falsifying them leads to legal trouble, that reinforces their status as something of real recognized value.
That clarification on wealth is super important. It leads us straight to the next big question. How does this apply to the company actually issuing these rights in the first place? Is that act permissible from an Islamic perspective?
Yeah, good question. Based on our sources, the act of the company issuing priority rights is generally seen as permissible. It's often viewed almost like a gift or perhaps a donation from the company to its existing shareholders, a sort of reward, you could say, for their loyalty and past contributions. It distinguishes them fairly from non-shareholders, it doesn't seem to cause harm to anyone, and importantly, it doesn't contradict any established legal texts. So the default ruling here, since there's no prohibition, is permissibility.
Okay, so issuing them is fine. But then we get to what sounds like a much more dynamic area of debate among contemporary scholars. What about actually trading these rights? This is where things heat up, right?
Absolutely. This is where you see a real divergence of opinion. When it comes to the permissibility of trading priority rights for share subscription, there are two main camps among contemporary scholars.
Okay, lay them out for us.
Opinion one says, yes, it's permissible. This view is supported by some prominent scholars. People like Muhammad al-Mukhtar al-Salami, the preparatory committee for the Sharia board of Bank al-Bilad, Hamid al-Attar. Those are some names associated with this view.
Right, permissible.
Opinion two says, no, it's not permissible, and this position is held by other respected scholars like Siddiq al-Darir and Waba al-Zuhaili.
Okay, two clear opposing views. Let's dig into the first one. Why do those scholars argue that trading is permissible? What's their reasoning?
The proponents of permissibility, they usually offer two main lines of argument. First, they classify priority rights as financial rights. And since the basic principle, the default rule for contracts in Islamic law is permissibility unless something is explicitly forbidden.
Right. The default is okay unless proven otherwise.
Exactly. So they argue dealing with these financial rights for compensation should be allowed. Now, it's worth mentioning opponents sometimes push back on whether they are purely financial rights in the specific context, so it's not totally undisputed.
Okay, what's their second argument?
Their second argument is based on analogy. They draw parallels to other types of rights that are generally accepted as permissible to trade, things like commercial name rights or maybe intellectual property license rights.
Interesting comparison. So how do the opposing scholars, the ones who say not permissible, respond to that analogy? Do they just say it doesn't fit?
Well, yeah, opponents might argue that the analogy isn't perfect. They might say priority rights are different because they have this very direct, very imminent countervalue in the form of actual shares, which isn't quite the same for, say, a brand name right.
It's more concrete, maybe?
Perhaps, yeah. But the first group, the proponents, would counter that. They'd say, look, even if the outcome eventually getting shares is different, the act of trading right now is similar. It's a trade of what is currently just a right. And what it might turn into later doesn't necessarily change the ruling on whether you can trade it now.
Okay, that covers the permissible side. Now let's flip it. Why do some scholars argue that trading priority rights is not okay? What are their main objections?
Well, the arguments against permissibility usually focus on two key points. First, they argue it's a mere right, just an abstract entitlement acquired purely by purchase, and that kind of mere right shouldn't be exchanged for compensation. They often bring up the principle of profit without guarantee. This is a really fundamental concept in Islamic finance.
Right, I think you mentioned it earlier, earning profit without bearing risk.
Exactly. The idea that you shouldn't profit from something if you don't also bear the potential downside, the risk associated with it. It's about linking reward to responsibility.
Okay, that's the first point. What's the second?
The second argument is tied to our earlier discussion about wealth. They contend that priority rights themselves aren't wealth in the tangible sense. Rather, the holder just has the option, the right, to buy shares. They don't actually own the shares yet.
So it's potential wealth, not actual wealth at that point.
Something like that, yeah.
Well,
that's the argument.
Okay, those sound like pretty significant counter-arguments, especially that profit without guarantee principle.
Yeah.
How do the proponents, the ones who say trading is permissible, push back against those specific objections?
They have some strong counters. On the mere right point, they really emphasize that these rights are not just abstract or mere. They're directly, intrinsically tied to the underlying shares being issued. And crucially, they circle back to the point we discussed earlier. When these rights are issued, the market value of the existing shares tends to decrease by the value of the new issuance.
Right, the dilution effect again.
Exactly. So if an original holder doesn't use or sell their right, their existing shares lose value. That represents a real potential cost, a real exposure. So there is risk involved, even for the original holder.
Okay, so it's not risk-free for the holder. What about the buyer?
And for the person who buys the right, they absolutely bear risk too. If they buy the right, but then, for whatever reason, don't subscribe to the shares before the deadline, they lose the money they paid for the right. Poof, gone. And if they do subscribe, sure, they might gain if the market price is higher than the issue price. But they're also immediately exposed to all the normal market risks, price fluctuations, the company's performance, even the possibility of bankruptcy down the line. So they argue the profit is definitely not without guarantee. There's clear risk involved for both parties.
That seems to address the risk point quite directly. What about the argument that the rights aren't wealth yet?
On that one, the proponents basically say, look, that argument just isn't accepted based on the preferred, broader definitions of wealth we talked about earlier. The fact that the rights haven't physically converted into shares yet doesn't mean they aren't considered wealth, a valuable, tradable asset right now, according to those mainstream definitions.
Okay, so after laying out all these arguments and counter-arguments, what's the sort of bottom line? What's the prevailing or more widely accepted view according to the sources you looked at?
Well, our sources clearly suggest that the preferred opinion, especially after a lot of contemporary scholarly review and debate, is that trading priority rights is generally permissible. However, and this is really crucial, it's not unconditional. It comes with very specific, important conditions attached.
Conditions. Okay, that sounds vital. What are those conditions for the trading to be considered okay?
Yeah.
These seem essential for anyone actually thinking about doing this.
They absolutely are essential. For the trading of priority rights to be permissible, the sources highlight these points.
Hmm.
One, the conditions of these rights, what they entail, how they work, must be fully known, specified, and clearly defined right when they're issued. Transparency is paramount.
No hidden clauses. Makes sense.
Two, issuing these rights must not cause harm or infringe on the rights of others. For example, you couldn't issue them selectively just to a favored few shareholders. They have to be offered fairly and universally to all eligible existing shareholders.
Fairness.
Three, the company issuing the rights must itself be involved in permissible, halal activities. The underlying business matters.
Right, the source of the shares.
And fourth, and this is very practical, the regulatory system or the prevailing laws in that market must explicitly permit their trading. This is important to avoid disputes and ensure there's legal certainty for everyone involved.
Okay, so transparency, fairness, permissible underlying business, and legal regulatory permission. Those are clear conditions. And finally, just to cover all the bases, what about brokerage? Is it okay to act as a broker, facilitating these trades and taking a commission? Does that follow the same logic?
Yes, exactly. The ruling on brokerage really just flows directly from the ruling on the trading itself. So if the trading of priority rights is deemed permissible because all those conditions are met, then providing brokerage services for those trades is also permissible. And consequently, taking a fee or commission for providing that brokerage service is allowed.
Wow, okay. This has been a genuinely illuminating deep dive. We really covered a lot of ground. We started by getting a clear definition of priority rights, those tradable securities giving you, the existing shareholder, the first bite at the apple for new shares. We walked through the practical steps, the choices you face. That Mohammed example was really helpful.
And then we dug into that crucial question of whether these rights count as wealth, as mal. We concluded they generally do, which is fundamental for their permissibility. And of course, we spent a good amount of time exploring that fascinating scholarly debate on trading their rights. We looked at the arguments for, the arguments against, and ultimately landed on the view that trading is permissible, and it's big, but only under those very clear, specific conditions needed to ensure fairness and prevent problems.
It really is fascinating how financial innovation like this requires such detailed ethical and legal scrutiny, isn't it? So here's maybe a final thought for you, our listener, to chew on. How might those specific conditions for permissibility, especially needing regulatory permission and avoiding harm, how might they shape the way brand new financial instruments get developed and accepted in different markets around the world in the future?
It's a great question. This whole topic really underscores how these complex financial ideas intersect with very detailed jurisprudence. It requires constant, careful research to arrive at conclusions that are both sound and reassuring for people navigating these markets.